All right, thanks, Kyle. Thanks, everyone, for being with us today and taking a deeper dive into some premium finance case design. So hopefully you'll find this presentation uplifting and knowledgeable, and gather a few sales ideas that you can apply to your practice. So the first thing I want to do, and if you've listened to our first two premium finance presentations, this is maybe a little bit of a refresher, but just generally want to go over what premium finance is and what some of the moving parts are and what's involved in it. So basically, premium finance is when a client borrows money, typically from a bank or a premium finance lender, to pay premiums for a large life insurance policy. And in order to do that, the bank wants to be fully collateralized. So they want to have the client post collateral for the difference between the cash surrender value of the policy and what the borrowed amounts are. So the actual life insurance policy itself is going to have a collateral assignment on it. And what that means is if the client surrenders the policy or passes away, the bank is going to get first dibs on that cash surrender value or the amount of the death benefit in order to repay the loan balance that is owed. The difference between the cash surrender value and the value of the loan has to be made up with outside collateral. And typically, banks will require things like CDs, money market accounts, mutual funds. Sometimes you can use bonds, stock portfolios. They might not give you 100% of the value of that because of the fluctuations in the market. But you have to provide that gap collateral in the difference between the cash surrender value and the amount of the loan outstanding. So when you look on our illustrations, there's a column in there in the premium finance supplement that's labeled borrower's equity. And when that column is a negative, that means that that's the gap collateral that the client has to post. That's the number, that's the difference between the cash surrender value of the policy and the amount of loan outstanding. Ultimately, what happens is when the client passes away, the net death benefit that goes to the beneficiary of the policy is the amount of the policy, and typically we design these policies with an increasing face amount so that the death benefit of the policy minus what we pay back to the lender is pretty close to what the original face amount of the policy is. And you'll kind of see how that works on some of the illustrations. So the beneficiaries are ultimately going to receive the difference between the death benefit of the actual policy itself and the amount of loan that's still owed to the bank. And that difference is what we call the net death benefit in the illustrations. That's the net death benefit after we repay back the loan that the beneficiaries are actually going to keep. So ultimately, in most premium finance designs where the insured is probably under the age of 65, there is a design where we actually have it built in to pay back the lender. And typically we would try to repay or illustrate repaying the lender by taking a distribution from the policy values itself. So that's why we fund these policies up to the maximum, up to the 7-pay limit, so we can turbocharge that cash value, increase that death benefit, and then have enough money inside that policy to repay back the loan. So eventually we can stop making interest payments on the loan, and then we own the policy free and clear without a collateral assignment on it. And the net death benefit after we repay back the loan is obviously the same as the death benefit of the policy itself. So I just wanted to give you a little bit of background of what premium financing is. And why would you want to do premium finance, go through all this trouble? Well, a couple different reasons. Number one, premium finance may help you reduce your out-of-pocket costs, right? Instead of paying the full premiums themselves, typically you're only paying a portion of the premiums, or just the interest cost of the loan. The second and probably most important reason is retained capital. Many high net worth people have large amounts of money that are invested in their business, their stock portfolio, maybe real estate, and they may make double-digit returns on those investments. So they might not want to liquidate assets in their existing business or investments in order to pay large life insurance premiums, or those investments may be in qualified funds, have large taxable gains. There might be tax consequences for liquidating those investments, and so they want to retain that capital or maintain their liquidity and investments intact and not have to liquidate those in order to pay large life insurance premiums. So that's where premium financing comes in. Instead of having to liquidate those assets, they go to a bank, they borrow the money. Ultimately, the goal is to borrow money to pay the premiums at a lesser cost of capital than what they're earning on their current investments. So right now is a great time for premium finance. So right now you can borrow money anywhere, typically anywhere between 2.6 and 3.5%, which is a typical rate on a premium finance transaction, which is a low cost of money. If the client is earning 10, 11, 12% on their investments, that makes sense. You borrow money at 3.5%, you keep your money earning those double-digit returns, don't have to liquidate them. It's a perfect way to do business. And many of your high net worth customers, they're used to using leverage, using that type of concept in their business, especially if they've started a business, bought in land, bought in real estate. A lot of times they did that by borrowing money from a bank. So they're used to the concept of leverage. So I just wanted to give you a brief background on what premium finance is before I turn it over to Keaton for a case study. Keaton, like Kyle said, has had a lot of success in the premium finance arena in his region. He's become very knowledgeable on premium finance, has a good rapport with his agents and marketing organizations, and has been very instrumental in helping those agents place some very large premium finance cases. In addition to that, I believe last year, Keaton's region led all the regions in Lifetime Foundation Elite sales. So he's also an expert on that product and has helped agents place a lot of Lifetime Foundation Elite sales. And he's going to explain why sometimes at older ages, premium finance can be difficult, and why maybe instead of looking at a purely cash accumulation product like our Lifetime Builder Elite or Global Accumulator, why you might take a look at the Foundation Elite and where it might make some sense and be very competitive in some older age premium finance scenarios. So with that, Keaton, take it away.
Yeah, thank you so much, Jason, and thanks again to everyone who's joined us. As Jason mentioned, want to cover a case study with you guys when it comes to older age premium finance scenarios. Of course, when you run into premium finance cases on younger clients, there's a lot of great options out there when it comes to cash accumulation products. And when they're young and you're max funding for 7 to 10 years, the numbers add up and make sense, and it's usually a pretty great viable option to roll out, repay the lender without really having any issues. But when you run into those older age clients, usually once you hit that 60, 65, pushing 70 years old, using those cash accumulation IUL products just really doesn't work in the premium finance scenario, even if the premium financing itself makes sense for the client, because the costs within those policies often aren't built and advantageous for these older clients. Also, a lot of older age customers tend to be more risk adverse, so they like guarantees and sometimes maybe aren't as comfortable with just the strict IUL products. So that leads us perfectly to one of our newest products, Lifetime Foundation Elite. It's been around for a few years now and has really taken a hold on the marketplace, especially over the last year and now within the last few months with, GUL, VUL, NLG products being repriced, going away, this is a perfect alternative for those older age clients and specifically for premium finance scenarios, because this product is on an index chassis. So it still gives your clients that cash accumulation potential, which you really need in these premium finance scenarios to ensure you can repay that lender. But we're also going to be able to offer a guarantee for 40 years or to age 90, whichever comes sooner, as long as your clients are rated standard or better. So again, we're able to offer them that cash accumulation, make these scenarios work, but we're also going to be able to maybe calm their fears a little bit when it comes to the market and offer them those guarantees that they really like to see. And the kicker with this product is, on a current non-guaranteed basis, we also waive all charges after age 90. So when you're front loading this contract, which you do in these premium finance scenarios, and we're able to waive those charges after age 90, combined with the lower costs for these older age clients in the first place, this product is a really, really great fit in these premium finance scenarios. So we want to kind of dive into a case study to show you exactly how that might work for you and your clients. So we have an example here. On the right-hand side, we have Marlis. She is a preferred non-smoking female, age 68. Her and her advisors agreed that she has a $5 million need for estate planning purposes. But like Jason mentioned earlier, a lot of her net worth consists of investments, real estate, IRA holdings. So for her, it's definitely not advantageous from a tax perspective for her to liquidate any of those assets in order to pay large life insurance premiums out of pocket. So of course, premium financing makes sense. And when you look at the market and a typical NLG premium for someone her age for that $5 million death benefit, what we found is that premium is going to be about $105,000 to $120,000 per year. So it's a pretty big hit out of pocket for her if she were to just simply pay those premiums on an ongoing basis. So premium finance makes a lot of sense for her with where her assets are. She understands the risks that can come with premium financing and does have the ability to post some of her investments as collateral to secure the loan from the lender. So what we're going to do with her is she's going to have a $380,000 premium for the first 7 years, $300,000 of which she is going to borrow from the lender at a rate of 3.5%. Like Jason said, the rates we've seen over the last couple months are actually significantly lower than this, so it's a great time to borrow. However, this just gives you a good idea with a flat 3.5% of how this would work. And of course, the lender does have that collateral assignment on the policy just to ensure they're able to recoup their loan balance no matter what might happen in this scenario. And then she is required to post her outside collateral with the lender for the difference in her cash surrender value and the total financed amount. And the setup we have here, which we really, really like and makes a lot of sense for most clients, is she's just going to pay a flat amount of $80,000 per year in this scenario. So it's going to set her up for a premium she knows that she's going to pay. And for the first 7 years, $80,000 worth will be paid towards the premium. And then years 8+, her $80,000 will cover some of the interest that's accruing within her policy. And of course, we are going to set this up with an increasing death benefit. Like Jason said, we need to max fund these contracts, increase that death benefit so we can ensure that Marlis and her beneficiaries net the death benefit, in this situation, $5 million that was initially needed after the lender recoups their portion of the loan. And with older age clients, we actually do not use a loan for that rollout to repay the lender. With these older age clients, of course, there's just not quite as much time for that cash value to build where the policy can sustain a large loan to repay the lender. So at her age of 68, we're simply going to use death as an exit strategy for her. So when she does pass away, the lender will recoup their portion of the loan, and again, her beneficiaries will net the $5 million need that she had. So this slide shows our premium finance supplemental illustration report that is on all of our financing cases. It's really a great snapshot and breaks down everything that we've discussed and kind of shows you on one quick page everything that's going on within a premium finance case for you. So I'm going to work left to right on your screen and just quickly walk you through what we're looking at here. So as you can see, she's got that $380,000 premium for the first 7 years, and the financed amount that she's borrowing is the $300,000. And then if you jump a couple columns over, you can see the interest rate, which we started at 3.5%. For this example, we upped by 50 basis points every 5 years. And you can see that interest that's accruing on the financed amount, which then in that third column, adds up and continues to total throughout the years. So for her annual outlay, which you can see is $80,000, $80,000 of which is paying for the premiums in the first 7 years, and then going forward is helping pay the interest on her loan. This is a big deal, as you can see, for the first and foremost reason, when this is accruing, obviously the interest can add up. So assuming she lives to life expectancy, that's another $1 million+ that she's going to owe back to the lender. But by paying that interest down with some money out of pocket, she has a vested interest in this policy. It's much safer for her, and in turn makes this policy sustain a better cash value and ensures that net death benefit is there when she passes. So if you continue to the right there, you can see the account value and surrender value, which then shows her equity within the policy, which helps determining what collateral might need to be posted depending on how this policy performs for her. And then that last column is our net death benefit column, which again takes all of this into account, including the financed amount, and shows if she were to pass at that age, what the net death benefit would be for her and her beneficiaries. So as a recap, she's paying $80,000 per year out of pocket, which is a huge savings for her when you look at, again, just paying an NLG, GUL type of flat premium in all years. So she's going to be saving 25 to 35% just by utilizing this premium finance design. And she's still able to accomplish the scenario and goal of that $5 million need. So at age 85 in this example, her death benefit on the non-guaranteed side is a little over $8 million. But she has that loan balance outstanding of $2.7 million. So if she were to pass at life expectancy, as you could see in that chart before, she is still going to net a little over $5 million for her estate planning purposes, which is why we dove into this policy in the first place. So hopefully this gives you a really great idea of how you can use our Lifetime Foundation Elite product in these financing scenarios for these older age clients when maybe the numbers initially don't add up. So that's all I have today for our Foundation Elite product. Definitely let us know if you have any questions at the end of this, and I'm going to pass it back to Jason, who's going to cover another case study for you for older age clients when you need to use possibly a term blend scenario.
Thanks, Keaton. Great presentation, some good points. We have placed a few Foundation Elite cases for premium finance. It's actually very competitive in the marketplace when you're looking at a probably 65 to 75-year-old that you want to look at premium finance. The Foundation Elite is extremely competitive. A lot of the times you can get the job done with perhaps just using a 7-pay scenario versus maybe if you're using a cash accumulation product, you might have to use 8, 9, or 10-pay. And what that means is less out of pocket, less collateral, that sort of thing. So take a look. If you do have an older age case, give us a shout. We can run the numbers on a Foundation Elite and see if it can fit the bill for your sale. So appreciate it. I'm going to talk about utilizing the primary insured rider, the PIR, in premium finance cases. So a lot of you may be familiar with what the primary insurance rider is. Many people refer to it as a term blend. Basically what that means is that you're converting or splitting up some of the base face amount into a non-commissionable term rider. And I'll show you some example of that. So what you're accomplishing by doing a term blend or utilizing the primary insurance rider is that you're reducing the internal cost within the policy in order to make it more competitive. And why might you want to do that? Well, number one, you may be in a competitive situation. Maybe you're competing with another agent that's showing another company besides Global Atlantic. I don't know why anybody would do that, but sometimes that happens, right? So you may want to put your best foot forward. It might be a big case. Maybe you really need this person as a client. It's a center of influence. Sometimes you can use a term blend in order to reduce the internal costs in the contract in order to increase the cash value and make the illustration look a little bit more competitive. Another reason that you might utilize a term blend or the primary insurance rider is older ages and or rated cases. As Keaton alluded to, when you really get above the age of 60, sometimes premium finance, the numbers just don't work out as well. The cost of insurance, the internal policy fees are higher. You typically have less time for the policy to accumulate cash. The cash value accumulation is lower. You're kind of in between, kind of too old, too young for the client to really use death as a rollout because they may have a life expectancy of 20, 25, 30 years. But you're not generating enough cash to really roll out using policy values in 12, 15 to 17 years. So that's where we might utilize a term blend in order to juice up the cash surrender value and the cash accumulation inside those products to make it look a little bit more competitive. And the same thing can go if you have a rated case, or maybe you showed the client, and this has happened to everybody. You showed the client preferred or premier, and now they're standard at table 2. And in order to get the cash value and the performance that you want, maybe you need to utilize a term blend to kind of even the playing field a little bit. One of the reasons that you may need to, or it might behoove you to use the PIR rider in premium finance is to increase the early cash values to pay off the policy loan. So typically in a premium finance case, in a younger age, you're going to try to build up enough cash within the policy to repay the lender anywhere between year 11 to year 17, typically, sometimes year 20, depending on age and how you have it designed. So when you use the PIR rider, you're reducing expenses inside the policy, which gives it the greater opportunity to accumulate better cash value. More cash value means that you can maybe repay that lender a little bit earlier. More cash surrender value also means less collateral requirements, outside collateral requirements. Remember, Keaton alluded to it too, your outside collateral requirement is the difference between the cash surrender value of the policy and the amount of the loan outstanding. So if you have a higher cash surrender value, that means less outside collateral that the client has to post. And do not poo-poo the effect of collateral requirements on a premium finance case. That is the reason why more premium finance cases fall apart than just about any other reason, is clients get surprised or shocked by the lenders asking them for outside collateral if it's a little bit more than they expected. So using a term blend in certain situations, if needed, can help boost the cash value of the policy and lessen that outside collateral requirement. because we're enhancing the performance of the policy, maybe by utilizing a term blend, we can use less years of premiums. So sometimes, like at age 60 plus, the numbers don't quite work out with a 7-pay. Sometimes we have to do an 8-pay, 9-pay, a 10-pay in order for the numbers to work out. Well, what happens? You're borrowing more money, right? So that means more out of pocket. That means the interest costs are higher. That means perhaps collateral requirements are higher. You're going through extra loan renewal process. There's just a little bit more risk to the transaction the more money you borrow and the more premiums that you need to make the plan work. So by utilizing a term blend, sometimes we can design it with less years of premiums than if we did not do a term blend. So here's kind of the case, a 60-year-old client, standard non-smoker. Maybe we showed him preferred or premier, and doggone it, he got standard. My underwriter, Jack Nance or Steve Harris, didn't give us a solid, and we got standard instead of preferred. Everybody's had it happen to him. Well, at standard rates, if you kind of look at this premium finance proposal, it doesn't look as good as it probably should look, right? So if you go down to year 18. We're using cash value to pay off the loan. In this particular case, the client's paying interest out of pocket in all years. So the amount of the loan repayment is the sum of premiums paid. If you look at the collateral requirements, because it's standard rates, policy expenses and COIs are a little higher. Collateral requirements are going to be a little bit more than they were at preferred or premier rates. So the client's posting more collateral than maybe what we expected after we repay back the loan. Look at our net death benefit. Because we had to take a big chunk out of the policy to repay the lender, our net death benefit drops at age 85 to about $7.6 million. So it might not be a deal killer, but probably doesn't look as good as it did at preferred or premier rates, right? So what can we do? Well, one of the things that maybe we can look at is to utilize a term blend. And this is an example of, and this is probably a good exercise, not only in premium finance, but if you guys ever mess around on our software, to actually run a policy expense report. And this is a supplemental report that's actually available on our illustration system. And for somebody that wants to know how universal life works or IUL works, this is a great page to show them. So here you can see what our planned premiums are, what the premium expense charge is. Maybe a lot of people call that a sales load. It's 6% of the premium, the annualized policy fee, the policy expense charge, the COI, which is basically the actuarial cost of the client passing away. You can see actually how our wellness rewards look. Everybody has probably listened to a presentation about the wellness rider. You can see the credits that are involved with that, and then how they affect the COI charges. And then you can see what the surrender charges are in the policy. So this is what the charges are with all base coverage with no blend. So one of the things I want you to remember are the policy expense charge, $112,200, and the surrender charge in year one, $417,600. Remember those numbers. So PIR summary, what does it do? Reduces the policy expense charge. Because we're reducing that policy expense charge, in that particular case it was $112,000. We're going to show you how doing a little bit of a term blend reduces that. You're going to have better cash accumulation. Using a PIR also reduces the surrender charge. So that's going to mean that the illustration is going to have a higher cash surrender value. So what does that mean? The cash surrender value of the policy compared to the amount of loan outstanding is what your outside collateral requirements are. So if your cash surrender value is higher, that means the client's going to have to post less collateral on their premium finance transaction. It's a good thing. Again, that lowers collateral requirements. One of the things, obviously, with PIR is that it reduces commission. So if you're doing, a 50-50 blend, the target's 200,000, you're doing a 50-50 blend, now the target's only going to be 100. So you are sacrificing, commission and compensation in order to make the policy perform better. Let's not beat around the bush. It is what it is. If you do utilize the early cash value rider, and for those of you that didn't listen to the first premium finance webinar that we did, PF 101, I would implore you to do that. We showed some examples of our early cash value rider and how it can really help your premium finance sale. So to make a long story short, the early cash value rider with us, it guarantees the surrender value of the policy to be the sum of premiums paid, typically for the first 5 years. And so if you're paying interest on the loan, if the cash surrender value is equal to the sum of premiums paid, and you're paying interest on the loan, that means that your loan balance is the same as the cash surrender value of the policy. And that means that the client may not have to post outside collateral with the lender. So that's a very powerful tool. And the ECV rider is used on about 50% of our premium finance cases with Global Atlantic as a whole. And there are some caveats with that as well. There's reduced compensation, extended chargeback period, a charge on the policy. There's no such thing as a free lunch. But wanted to make you aware, if you're running the illustrations and you're trying to use ECV, a 50-50 blend is the maximum blend that you can still use and still have the early cash value rider. So here we can see the effect. In this particular case, we're using the same $10 million death benefit, 60-year-old standard non-smoker, paying the interest. In this case, we've got a $6 million base, $4 million insured rider. So in layman's terms, it's a 60-40 blend. If we look at the illustration, our borrows equity and policy, that's our collateral requirement. It's a lot lower than it was with a non-blend. Our cash surrender value is better. And look at the net death benefit at age 85. On this case, because we've enhanced the performance of the policy, our net death benefit is about $10.5 million versus without a blend, it was only about $7.6 million. So in this case, you can see by utilizing a term blend, our premium finance proposal looks a lot better, looks great, looks how it's supposed to, probably helps us get the sale versus if we did not do a term blend, we may not get the sale. Here's an example of what I was talking about. Here's the fees with the term blend. The big thing is look at the policy charge. Our policy charge there is $71,800 versus $112,000 with a non-blend, and the surrender charges are a lot less, $250,000 versus I think 400 and some thousand without the term blend. So basically, what we're doing, using a term blend, reducing the expenses in the policy, helps the performance. This is just kind of a summary. All base, the policy expense charge is $112. With the blend, it's $71,800. The surrender charge, $417 versus $250. Year 5 cash surrender value, $2.6 versus almost $3 million. Year 10 accumulation value, $4.9 million versus $5.5 million. Target premium, obviously here's the kicker, $432,000 all base. If you blend, obviously you take a commission haircut. The target premium's about $259,900, but I would say is $259,900 better than zero? I would say yes, right? If it's a difference between making 259 and not making anything, I think most people would probably choose to make 259,900. So this is where term blend really comes into play, helping out these tougher cases, the rated cases where you're in competition, older ages, makes the premium finance design go a little bit better. Yeah, you're sacrificing some compensation, but you may get the sale where if you didn't utilize a term blend, you may not get it. The last column is the projected collateral. In year 5, with all base, the outside collateral requirements, $794,000, and by utilizing a term blend, it's only $406,000. So that's a significant amount, right? So depending on the situation of your client, an extra $300 and some thousand dollars that they can save on collateral is probably a big deal. So that kind of does it with the case study there for term blend. If anybody has any questions, we're getting a little bit short on time, but I do want to go into a little bit of what goes involved in case review. Premium finance involves a lot of moving parts. At the same time that they're underwriting the life insurance application, you're submitting a loan application to the lender. So there's basically two sides to the coin that the client has to go through. And then typically every 5 years or even sooner, depending on the lender, the client may have to go through a loan renewal process where they might have to submit all new requirements again. So make the clients aware of that every 3 to 5 years, they may have to reapply for the loan. Every year, the client's going to have to post collateral. And what happens is the lender will call or submit a request to us for a low point valuation of that policy. And what that is it's the projected worst case scenario of the policy for the next 12 months up to the policy anniversary. And here's an example of a letter. We've got a policy number there, and we say, assuming no policy changes are made and the scheduled year 5 premium of $339 is received around the anniversary date, the low point cash surrender value as of June 28, 2021 would be $1,696,147. So the lender is going to get that letter, and they're going to say $1,696,147 versus what my loan balance is. And the difference between the loan balance and the number on that letter is what the clients will have to post in an outside collateral. So a lot of people don't really know what goes on behind the scenes. That's exactly the transaction that takes place between us and the lender. Now, what I would implore you to do, and some of the mistakes that I see made, is we see clients and agents try to go year by year with collateral requirements and maybe wait for crediting and things like that before they post additional collateral. Some lenders don't even let you play that game. Some lenders will make you post the 5-year high point of collateral up front so they don't have to go through that exercise every year. So for example, if we go back in this situation, if we look on this illustration right here, and again, this is at current rates, and the lender is going to make you post collateral based on 0 or 2%. With us, it's 2%. So in this particular case, in the first 5 years, our maximum collateral is $498,433. So what I would do if I was selling this, and what the experienced agents do, instead of having the client only post the $375,501 in collateral for the first year, is to go ahead and move assets around and actually have money funded in that collateral account for the $498. So you don't have to mess with it. The client's not going to get upset if you have less than expected crediting or jump in interest rates. they're already going to be collateralized for that high point in the first 5 years. That's what the experienced agents do. In fact, that's what a lot of the premium finance lenders actually require, is to actually make you post the high point collateral number. So that can save you a lot of headaches, believe me. Also, make the client aware of the impact of interest rates, loan rates. The loan rates from the lender are typically not guaranteed. They fluctuate with an index, typically the LIBOR, maybe the prime rate. So if interest rates go up, your client's out of pocket goes up, maybe their net death benefit goes down. Make them aware of that. Crediting rates on the policy, if you get a flat rate, 0% credit, obviously that means lower cash surrender value, less increase in the death benefit, more collateral requirements. Make them understand that. And also, if you're taking a policy loan on the contract, you take a large policy loan to pay back the lender. Obviously, you're putting stress on that policy by utilizing that loan. If you use a variable loan, the net cost of the loan obviously is tied to the crediting rate of the policy. So if you have a period of high interest rates and low crediting rates, the net cost of the loan can really eat into the value of the policy and perhaps even make it in danger of lapsing. So really monitor that. Get in-force illustrations at least annually. You should probably do that on all your cases. But the thing that I always say, you run these illustrations, they show the same interest rate in perpetuity, for 50 years. Has the market actually ever done the exact same return 2 years in a row, much less 50 years in a row? The answer is no. So after the first year, or as soon as that policy is sold, your in-force illustration or your case design is going to look different than what you showed the client. And that's the truth in all of the cases. So make your client aware of both the positive and negatives of premium finance. The positives, we talked about leverage, retained capital, maybe some gift tax savings, lower out-of-pocket costs. Some of the negatives, maybe if interest rates go up, policy performs less than expected, maybe the client has to pay a little bit more out of pocket, results in lower net death benefit. If you're using death as an exit strategy, if the client has a longer than expected life expectancy and interest rates go up, it may eat into the death benefit quite a bit, and they may get less death benefit than what they expected. So again, there's a lot that goes on behind the scenes. It's important to do your due diligence on these, not only during the sales process, but after the sales process as well. So with that, pretty much done. I don't know if we've got time for a few questions or not, Kyle.
Thank you, Keaton. Thank you, Jason. We have been answering most of the questions that have come through. So if you have a question that you want to sneak in here for Keaton or Jason to answer, go ahead and use that Q&A feature at the top of your options tab there, and we can ask that question. I do want to thank Jason and Keaton for their time today, and I want to thank all of you for attending. We had a great turnout. We will be getting you a copy of this recording and the presentation and a follow-up email. Usually that comes probably tomorrow, worst case 2 days from now. So we'll give you that. Also, we have another premium finance session for 3 p.m. tomorrow, 3 p.m. Central Standard Time, where we're going to kind of explore more of that kind of lender side of the transaction. Have one of our partners that we work with on the lending side that are going to be available for some questions and kind of provide some perspective. So definitely check out that. Let's see if we have any questions that came through. It looks like we've gotten most of them. So kind of, Jason, to kind of recap it, when you're looking at maybe older clients, Lifetime Foundation Elite might be a viable solution with its combination of guarantees, cash accumulation, and then from a competitive standpoint, usually a significantly less premium than a no-lapse guarantee solution, and you couple that with a premium finance technique, for a portion of the premium, makes it a pretty competitive solution. So that was kind of the first section, right?
Yep, exactly. Yep. Showing how the Foundation Elite, that even though it's not a cash value accumulation product per se, that it does fit a niche in premium finance, just because of the way that it operates, with the extended no guarantees and the waiving of the charges on a current non-guaranteed basis at age 90 if the parameters are right. It does fit a niche for probably insureds over 65. It's pretty competitive. And then to kind of recap the term blend or the primary insured rider story, again, maybe older ages, rated cases where you need to be a little bit more competitive. If the numbers don't look right, don't automatically dismiss the case. Take a look at adding a term blend. You sacrifice a little bit of compensation, obviously, but in doing that, you're enhancing the performance of the plan, and it might allow you to get the sale where otherwise it may have been lost.
And then they can contact our advanced markets team, Jason, if they do have a potential case and they maybe need some help, whether it's just the case design or they're kind of trying to work some numbers in and kind of finding that sweet spot between base coverage and the term blend. You and your team can kind of assist them with that process, correct?
Exactly. Probably the easiest thing to do is email us these days, as we're all kind of working remotely like everybody else. And that email is advancedmarkets@gafg.com. And we can help you out with the case designs, the premium finance supplements, help work you through the case. May even be able to make a connection with a lender if your case advances that far and you need some additional help.
Excellent. Well, it looks like we've answered pretty much all the questions. Again, going back